we've got a lot to talk about today. A couple of things may have shifted a little bit, so we'll address that. I also want to talk a little bit about urban-suburban dynamics. I also want to talk about our sortable stats tool, if time allows, at the end. And I'd also like to do just a 5-minute quick overview of InfoSparks. I know that's ambitious for an hour, but let's see how we do. Okay. You know, all the great public speakers say start with a shocking fact, and that'll hook people in so they won't be, texting or Facebooking during your presentation. So here you go. Our water is so old, our fresh drinking water is so old that statistically, every time you drink a glass of water, you're probably drinking water that has passed through the body of a dinosaur. What do you think about that? Pretty crazy if you ask me. Anywho, all right, let's jump right in the market. Showing activity. This is through just a few days ago. This is through Sunday, I believe. And you guys can see, as we've covered this every time for almost a year and a half now. So I insist on showing this to you guys because showings are a great leading indicator for demand. Mortgage approvals are also a great leading indicator for demand. If I'm a serious buyer, I have to see the place and I have to be pre-approved. They're almost non-optionals, unless you're an investor buying 100 places sight unseen for cash. So, right, showing activity, right, we can see the 2020 decline. We can see just how strong 2021 has been until we kind of normalized and synced back up with 2019, as we can see here. So yes, we are down from last year. However, we are ahead of 2 years ago. So just kind of keep that in mind as we go through. So share of overall sharing activity. Nice. Share of overall showing activity by price point. This is MLS wide, and careful here, you guys. This is the most recent week this year versus the same week 2 years ago. So, we'll go through this pretty quickly. The percent of showings under 200K went from 30.5% 2 years ago to a little over 18% this year, most recently. We also see declines in this 2 to 250 segment, a very small gain. We squeaked out a very slight gain between $250,000 and 300K. And then you start to see these pretty massive gains in market share. Again, as you get into maybe some of the move up markets, this used to be entry level, right? 180 used to be an affordable entry level home. Good luck. And so, I think now we see 325, 350 a lot of the time. And then that move up market, maybe 4 or 4.25, getting into the 550s, depending on where, the Lakevilles and Blaines and Woodburys, kind of depending a little bit. All right, so looking at this another way, change in showing activity. So this is not the market share, but the actual percent change. Where do we see our biggest winner? Looks like 110% gain and million plus. Our luxury segment has been high flying lately. Again, we see our losses in our most affordable ranges. And so that amounted to an 11% gain in showings over 2 years. So just a word of caution here, it's not just that there aren't all that many homes listed under 250K. It's also that what was listed, last year, what would have been listed at 240 would probably now be listed for 270. So listings kind of age out of each cohort, and they're owned, typically held for longer, because where else am I going to go where I could have that sort of payment? So a few considerations there. Okay, change in new listings. Is seller activity sort of following buyer activity? Do we see sellers supplying product where that product is demanded? Kind of, I guess. There is a lot of this demand in some of these upper high-flying segments. And so we see an increase in listings there. Some of this is going to be builders and developers. Some of this is going to be folks, selling 325 and getting into 475 or something like that. On the demand side, so maybe sellers aren't so crazy. Maybe they are fairly well matched up with where these gains in demand are. I think we'd like to see a gain in demand here. I think there's more buyers that would love to be successful in this category. For obviously reasons, they're just finding that challenging. So down only 0.8% over 2 years. That's an average of 0.4%, or it could be up a couple percent and then down. And so that would amount to, an overall 0.8% decline. We like to benchmark this against the NAR data, the national data. I think I joked in a presentation just the other day. We like to say there is no national housing market, right? The same way there is no national weather forecast. You don't grab an umbrella in Miami based on the forecast in Seattle, do you? No, that would be silly. So all real estate is hyperlocal. It's like saying, what's the average price at a garage sale? It's probably $1.50, maybe $2, $5. Doesn't mean there aren't 50-cent items, and that doesn't mean that someone couldn't buy, a car for 50 grand at a garage sale. I don't know. So just keep that in mind. However, we do show consistency with the national trend. So again, it's always nice to sort of benchmark ourselves, our region, against the nation as a whole. Okay, another way to think about this is just kind of co-plotting all of both of these indicators, sort of new supply and then demand. So new supply entering the market, and then demand flowing off the market, listings flowing off or going under contract. Not all of those sell, but the vast majority do close. So, okay, change in market activity. Oops, sorry about this, you guys. This is supposed to be compared to September 2019. I got cut off, and now I'm jumping slides. I'm all over the place. Okay, so over 2 years, look at the change in seller activity versus the change in buyer activity. You can see the change in buyer activity for the most part, this range notwithstanding. For the most part, seller activity actually declined more than buyer activity, right, in all these price ranges. And it's actually a fairly similar story, although on the plus side, demand in blue has outpaced growth in supply in gray, right, in every single price point over 250K. So our sales growth has outpaced our new listings growth, right? Sales up 9%, new listings only 7.5%. Here, sales up 88%, new listings only up 12%. So I think it is useful to sort of plot these together and look at some of our new supply entering and our demand sort of flowing off the market, to look at those, I guess you could say, inflows and outflows. And sure enough, our bathtub is going to be empty, right? The listing spigot, listings flowing into the bathtub. Demand, sales, listings flowing down, I shouldn't say down the drain, flowing out the flowing out the exit, maybe. Your inventory level, right? That's the level, that's the water level in the tub. Well, the new listing spigot, can sometimes be more open or more closed, and the drain, I guess, the sales drain diameter can also change and be dynamic. So, just a couple things to think about there. Okay, new listings. We are using sort of a seasonal, average. We're sort of we're simplifying the trend here. So no, this is not what new listing activity looks like. Nothing ever moves this smoothly in time. But, we have a seasonal market. So of course, January activity pretty slow. By June, July, sort of our, May, June, July, sort of our peak. And then we start slowing down again, into December. So all this is to say, take a look at 2020. One of these things is not like the other, right? As the song goes. You can see 2020, take a look. It started off really strong pre-COVID, right? So even before March, new listing activity in 2020, right, was pretty good. Did I say this year? I meant 2020 was pretty good. And then enter COVID. So March of last year, look at what it did to our new listing trend. It flattened us right out, didn't it? It flattened us right out. And so what sellers would have listed here, they ended up listing here. COVID postponed those decisions. Lots of reasons, right? Safety, not wanting people through your home, lots of different reasons. So the question is, are we able to make up these losses there? Make up these losses here with gains here. 2021 here in our black color here, sort of maybe looking a little bit stronger now because I think things were still flat just because sales are so crazy. If I list my home, where am I going to go? And so I think one of the keys to keep in mind is notice how 2021 was ahead of 2020, pretty much for the first half of the year. Well, yeah, I guess through August, so a little over half of the year. Now, right, even though 2021 seller activity is actually ahead of 2018 and 19, right, we can see that right there. And let me just zoom in a hair, right? So we can see 2020 activity still ahead of 18 and 19. Excuse me, God, I'm confusing you guys. 2021 activity ahead of 18 and 19, it is below 2020 activity. Forgive me for that, you guys. So here it looked like 2021 was well ahead of 2020, which technically it was, but that doesn't have much to do with this year as much as it has to do with last year, right? This year is more of a normal curve, more of a typical seasonal distribution. It was last year that was skewed. Okay, I spent too much time on that, but I just find that fascinating. I hope you do too. Otherwise, you're in the wrong Zoom. Pending sales. It's nice to be in the presence of people who understand and appreciate your work, because my wife and my two babies are getting so sick of hearing about it. Lord have mercy on them. All right, pending sales, you guys. Similar story, looking at demand last 4 years. So 2018 and 19, sort of here and here, looking fairly normal. 2020 sales activity looking anything but normal, right? Look at how much we flattened that curve. And I'm not talking about the COVID infection rate, but look at how much we flattened that demand curve, right? Because of COVID, right? So kind of mid-March there, see that flatten out, but look at how much of that was made up on the back end of the year, right? So again, all the losses here were more than made up there, but take a look at this year. This year, 2021, for the first half of the year, we looked stronger than the year ago levels, right? We were showing massive gains in pending sales. And then we showed a few losses. And, sometimes it's tempting to think, oh my God, there's no demand anymore. No one wants to buy a home. But the reality is, we showed double-digit declines, not because this year is weak, but because last year was particularly strong, right? The buying frenzy, the feeding frenzy, just the insane market that we saw last year. We can really see that visually here. Yes, we are below those levels. However, we are ahead of 2018 and 19 levels. And I think that's important. Actually, was it just yesterday we did our press release where we release September numbers to the media. And we were actually very pleased. CCO, Care 11, Strib, Bring Me the News, a couple others. Can't remember Fox 9 or CC. Fox 9 may have done something. But we're actually really pleased with how they picked up the story. Again, it's tempting to look at that year over year drop and say, oh my God, is the sky falling? Is the market crashing? This is another 2008 all over again, right? Don't be ridiculous, right? That's a really absurd claim. Again, has more to do, the losses right now have more to do with last year than this year. All right. Pending sales to new listings ratio, just understand that, 2020, that metric was really high. Here in 2021, it was high for the first half of the year. Looks like it's come down a little bit, but it is ahead of 18 and 19. Guys, really simple here. If we're at 100%, it means that for every new listing, there was a pending sale, right? At 90%, there were 90 sales for every 100 new listings. This is the pending sales to new listings ratio. At 150, right? There are 150 signed contracts for every 100 new listings. Yeah, kind of impressive. So, of course, demand is still fairly strong. Demand is stronger heading into year end, evidently, than supply is, and no surprise there. All right, long-term trends. When it comes to data analysis, you excel. All right, Housing Affordability Index, HAI. We haven't talked much about this, you guys. Those that have had the displeasure of joining us before. I'm just kidding. We haven't really covered this all that much, so I want to just address it. It seems like a big, scary thing. It's not a big, scary thing. Do not think it is some big, scary thing. It is simply, higher numbers mean higher affordability. Lower numbers mean worse affordability. So an index of 120 tells us that incomes are 120% of what is necessary to qualify for the median priced home under current interest rates. So 120 means that the median income is actually 20% higher than the minimum qualifying income for the median priced home at the current interest rate. So it's not, it's all right, maybe that's a little wonky, a little dorky, but it's not impossible to understand. I know you guys are brilliant. And I know you guys will get that. So look, affordability pretty low, no shocker, right? 05, 06, 07 in our bubble years, affordability pretty low. Some of you are going to be surprised by this. You're not going to believe this. Affordability has actually improved last year. Why? Well, incomes did grow, but also interest rates, right? Interest rates. Let's do two hypotheticals. Here, let's say our price goes up to 340 as, will it this year? It could, maybe 330, 335. We've had several months at 350. So I don't think we'll quite hit 340, but I think that's possible within the next few years. So 340 and imagine 3.5% on the 30-year fixed. So that would get us to a 128 affordability index level. And then how about 360K, but at 4% interest? I think 4% is a few years off still, but 3.5, it's possible later next year. Maybe that's a couple years off. It's possible maybe early mid next year. Depends on inflation and the economy and unemployment and everything else. So that would get us to 117. And you guys will see that is flirting with, that's pretty darn close with, sort of rock bottom affordability over the last, almost 20 years, 17, 18 years. So something that's worth noting. But let me also say this confirms that we have some runway ahead of us. We have some room to run. We're not going to max out. We're not going to hit our lowest affordability level, until we see 360K as a median price and 4%, which again, I think we still have a couple years on that. I cannot guarantee that though. All right, housing market activity. Well, that's what we've been looking at so far, but we're looking at new listings and closed sales all the way back to 1967. Some of you were born then, I was not. But I'll show you a chart back to that time anyway. So new listings in blue and then closed sales demand in red. So interesting little bubble there, right around that 1990 recession. Demand didn't really respond, right? We had a supply buildup. The market had to correct. All right, how about heading into the Great Recession, 07, 08? Wow, look at that buildup in supply. It looks like buyers were coming along for the ride at the beginning, right? Maybe because we had exotic mortgage loans and adjustable rate mortgages and balloon payments and 7-1, 5-1, 7-1, and 10-1 arms. And then that all went away. That all went the way of the dodo bird. And so we still see this buildup in supply, but then we start seeing demand decline. And so this led to a huge supply buildup. Of course, prices have to fall in order to clear the market of that excess supply. What do you guys see now? I don't see any oversupply issue. I see just the opposite. And I know all of you are feeling that as well. In bubbles, you guys, you almost always find that bubbles are supply driven. Look at the Dutch tulip bubble of the 1640s or the 1460s. I don't know. Google it, the Dutch tulip bubble. I'm blown away. People spent like 100 times the average, or is it maybe 10 times the average worker salary on a tulip bulb, something like that. Go read about it. It's crazy. So, no, I don't think prices are right. Well, yes, prices are rising quickly. That's sort of for other reasons that are much more, in the last 18 months. But remember, this only goes through 2020. And so you can see this market is being driven by supply and demand, right? It's not being driven by a supply bubble. It's being driven by just how tight the market is. And look at just how tight the market is. So just here again, right? A different way of looking at it. So, sometimes this looks kind of jagged and it's kind of hard to focus on. This shows what I like to think of as the macro trend, the high level 30,000 foot view, right? So market was pretty tight then, loosened up a little bit. Looks like it tightened a little bit, loosened up a lot heading into 07, 09, and look at just how tight the market is now. Very tight supply-demand balance there. Speaking of supply-demand balance, how about the ratio of sales to new listings, right? We just covered that on a weekly basis. How about on an annual basis? 84.5% ratio of sales to new listings. That is the highest figure we have on record, going all the way back to 1967, right? Where we had about 84.5 sales for every 100 new listings. Powerful stuff. Okay, so very similar here trend. You guys can kind of see the waves here. Again, I find that fascinating. I'm told, okay, 1600s for the Dutch tulip bubble. Thank you. I just learned that. All right, September new listings, guys. Taking a look at this, look where we were, look where we fell to, and then look where we are. So we saw last September, right, because of that pent-up, well, there was pent-up demand, but there was also pent-up supply where sellers didn't list earlier in the year for a multitude of reasons that are well known. So some of those listings had to come out later in the year. September was one of those months later in the year. So last year, we see this 12% spike followed by an 8% decline. We're still ahead of 2019 levels. I guess I'd call that encouraging given our chronic undersupply challenges. But just know that, no, that's not sustainable. There isn't that much supply ready to enter the market. So that wasn't sustainable. Now, I think this is an even more important metric when we think about the changes from 19 into 20 and then 20 back down to 2021. So September pending sales, there you have it, folks. There's your 30% gain, right? There's your 30% jump from September of 19 into September of 2020. 30%. Who thought that was sustainable? Who thought we could sustain 30% again for several years? I hope none of you did, because we can't. So we came down almost 14%. Again, it's going to be so tempting for the media to look at this and say, wow, are things unraveling? Demand has cratered 14%, right? Technically, that's true, but it's from a heightened, elevated baseline, right? So is 14%, is this really apples to apples, right? What part of last year is apples to apples with this year? Maybe January and February, maybe. Even then we have some seasonal differences, right? Is it warm? Is it cold? Do we have a polar vortex? These kinds of things. So yes, we've come down from these unsustainable levels, but we are ahead of 2019 levels. What is this? So call it 50-50 to 56-50. What is that? A little over 10%. Let's call it 10%. So that's about 5% per year. That's fine, right? That's not a bad number. So just keep that in mind. You'll see some extreme movement like that. Similar with closed sales, not the same extent. So just wanted to show you guys that one. And then market times, right? September, 15 days on market last September, 12 days on market this September. Because it's a median, half of the signed contracts, I should say, half of the listings go under contract in over 12 days. The other half of our actives go under contract in fewer than 12 days. Making sense of the dollars, as we say. September median sales price. This is September price for every year going back to 2003. 10% to $341,000. We did 11% last September, right? Again, a pretty hot month, not temperature, but market wise. Well, maybe both. And so, yeah, we see this 10%, which is definitely higher than average, but it is a little bit less than last year. You guys can kind of put this 340 in context with 330, where we were sort of at the peak of the bubble in 05 and 06. Okay, median sales price. I don't usually show you guys a table of numbers because I don't like looking at a table of numbers. If a picture is worth 1,000 words, then a chart is worth 1,000,000. I don't know who said that. I don't think it was me at first. So what do we notice? I see 350. I see three 350s here, right? June, July, and August, we were kind of steady at 350. For May, that 344 It's actually a 16.5% jump in median sales price, right? 16.5%. Okay, so we're back down to 10%, but I think I like to say the trend is our friend. And even though the rate of price growth is slowing, it's still positive and way above average. In fact, I think it's about twice average. I think we're much more 4 to 6, 4 to 6, 5 to 7%. That's before inflation, by the way. So 16.5 down to 15, down to 12, down to 11, down to 10. Prices are still growing quickly, but not as quickly as they were 4 or 5 months ago. I think that's worth noting. Put a different way, I love this one. It just shows, it doesn't show the price, it shows the change in price, right? We just looked at price. Now we're going to look at the change in price. Good old days, 04, 05, price is only rising 9%, right? Enter the crash. We had 1 month where prices dropped 25% from 200,000 to 150,000 or so, right? There's a 25% loss there. Tax credit, a little bit of stabilization, kind of had to find our footing before we had early phase 1 of recovery, strong recovery, right? Investors, flippers, other folks. And then we sort of normalized a bit. And then look at what's happened here, right? Something has changed. The world has changed. And it is so evident on our chart here. It has made its signature, made itself known. So pretty much every single month, and here, let's do our little zoom trick here. Zoom trick, that's funny. And so let's see, Jan, Feb, March, April, May, June. So starting in July of last year, right, after sort of a lot of the, how shall I say this? Not the panic, but I think when that initial pullback had begun to fade a little bit, and some folks were willing to jump back in, not everybody, but some were. I think you start to see the multiple offer situations start to come to the forefront. You see this competitive bidding environment. As you guys all know, right? You've been living that for, I almost caught myself saying 18 months. You guys have been living that since what, 2013, I think? It's been maybe 2014. It's been a long time of that competitive, undersupplied type of market. So yeah, there's our 16.6. Here's back down to our 10. Clearly, we are above average since COVID. Okay, percent of original list price. We've loved this one, right? We've always loved this one, but especially lately. We love all of our metrics just the same. We love all of our members just the same. So 101.2% of original list price received at the time of sale, at the closing table, right? So 100.5% last September, 101.2% this September, pretty far cry from 91% in 2010, 2011, and even a pretty far cry from 98 and a half, 98 and a third, 98.5% seen in 03, 04. Now, when did prices peak? Do I have to go back? Okay, so prices kind of peaked 05, 06, but wait a second. This indicator started to deteriorate 04, 05. Could that have been a leading indicator for us if we were paying attention to the signs back then, right? Back then, real estate could go nowhere but up. Buy, 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 right? And so, yeah, I think that's a pretty interesting little lesson there. And so, maybe as we see changes, now or coming up or, this winter or early spring next year, perhaps that could give us an early glimpse as well. Again, we're all about leading indicators. It's the thing before the thing, before the thing, before the thing, right? Let's see if I got that right. Pre-approval, showing, a listing's new, active, pending, closed, right? There's a life cycle here. Let's rewind back to June, shall we? 104.2% of original, not of current list price after a price reduction, but 104.2% of original. So sellers, you're getting 100% of your list price on average plus 4.2%, right? Now, there are still sales that sell at 80 or 90% of original list price. There are also homes that sell for 110, 115% of original list price, right? Know that those two things are still happening, and yet Our average, well, we also sometimes use a median. Those are called measures of central tendency. What is the central tendency of the group, right? Yes, it's an average, right? Okay. It's not everything is 104.2, but that is sort of that midpoint, that average where, there's some above and some below. So keep that in mind. Inventory, there's nothing to see here. We can move on. I sometimes make that joke. Guys, when you do stats for a living, you have to have some fun with it. So bear with me. Okay, so active listings. Some of you might give an arm and a leg to have half of as many listings as we had in 07. That would be about 18,000. I guess we haven't seen that since 2014. So 36,000 down to 8,500 is a 80% decline. Well, 75%, right? Nearly an 80% decline. So, we've only had population growth since 07. We've also had sales growth, right? You just saw how pending sales and closed sales are back to, right? Kind of back to those all-time highs. So this is an incredible data point, and we are using it. We are using our research and our MLS data to try to move the policy needle to get more homes built, whether that's regulatory reform, whether that's zoning reform, whether that's investing public dollars into housing of different sorts. That takes a lot of different shapes, but never has it really been more important than now. Month supply, we went from 10 months of supply in 07, 08 down to nowadays a month and a half of supply. What are we shooting for? 5 to 6, 4 to 6, even 4 to 7, I think is relatively balanced. But historically, it's 5 to 6, and some still use 4 to 6. So 6 months of supply, what do we have? 6 weeks of supply, right? Little bit crazy. We are still in a seller's market, a strong seller's market, the strongest seller's market we've been in for any September of any year, going all the way back to 04, right? Yes, there have been some changes. Yes, there have been a few shifts. But I think even the data is misread a little bit, like we talked about, right? Demand down 14%. Well, okay, that's from sort of remarkable highs. So just know, still very much in a seller's market. You might have some sellers who are approaching you saying, now, I hear we're in a buyer's market. So, how should that affect our strategy? Well, seller selected pricing, right? So month supply, as we think through this, I know some people, there's still some confusion around this. By the way, month supply, same thing as an absorption rate. Those are the same thing. They're synonymous. So sellers markets, right? You got a lot of buyers and they're all amped up. They're all excited to compete with each other over that one listing. It's a seller's market. This seller, they're in control, right? They have all the negotiating power. They're holding the reins. How about in a buyer's market? Here you've got more sellers relative to buyers. So what happens in this kind of environment? These sellers have to compete with one another through price drops, price reductions, price adjustments, right? And concessions and seller pays. You see that happening here. You do not see that happening here, at least not nearly as much. I know there are still seller pays and concessions, and some items from the inspection list might even be, repaired, assuming you didn't bypass inspection, of course. Is it such a radical request to ask for a balanced market, right? Where we've got pretty good balance between supply and demand. It seems elusive. Okay, you thought that was a little geeky. Let's do this one. So this is the Case-Shiller data. I don't often use the Case-Shiller data, but I am today, and you'll see why. And this is, I think it's every month of the last, is it 20 years? Does there seem like there's 120 dots on this chart? That'd be 240 dots, or could it be 10 years, just 120 dots? I thought it was 20. I'll have to double check. But anyway, this is all the different Case-Shiller data for the recent history, at least 10 years. And this plots, of course, change in price down here with inventory, or excuse me, month supply of inventory over here. So I know this is complicated. Let's try to think about, I mean, even I look at this and I say, okay, let me think about this for a second. Let's label our quadrants. These are undersupplied markets with falling prices, right? 0 to 6 months of supply. And look where we are here, negative on price change, right? These are undersupplied markets with rising prices. We're still under 6 months of supply, right? 0 to 6. But now we're on this side. We're in the plus side of prices. So undersupplied rising prices, oversupplied with falling prices, and then oversupplied markets with rising prices. So what do you guys notice? I can't see you. I'll tell you what I notice. There's nothing here, not a single thing. What does that mean? There's not a single time in the last, I feel silly, 10, maybe 20 years, where the national data, there's never been a time where we've had a seller's market with under 6 months of supply where we also had price declines. Let me say that again. We haven't seen a Case-Shiller month, right? We have not seen a market with under 6 months of supply that also had falling prices. There are no dots in this quadrant, right? None. No undersupplied markets with falling prices. There are oversupplied markets with falling prices, plenty of them. In fact, almost, well, not quite, but most markets with falling prices, all markets with falling prices are also sellers markets, right? Some markets with rising prices are also oversupplied or buyers markets, and we see that here. So we're still in the plus side of price movement, but now we're on the buyer's market side of absorption rates, right? So I know that was a little wonky, but just know so here's the big takeaway. Until we hit 6 months of supply, we are extremely unlikely to see softening prices. Let me say that again. Until we hit 6 months of supply, it is extraordinarily rare to see our prices fall. And by the way, we are a long way from 6 or more months of supply. Okay. It was a fun one. I know that was complex, but it's fun, right? Data is fun. Data is sexy. All right. Percentage of sales with a price reduction annually 03 through last year. 50% of our sales had to have a price, should I say adjustment? No, it was price reduction. Right. 50% last year, about 1 in 4. And that was the lowest we've seen since 03. That was the lowest mark we've seen going all the way back to 03. Last year feels old, right? It's almost November. That is just nuts. So let's take a look at August, more recent of 2021 here, 17.25%. That's the lowest August we've seen since 03, at least 03. I'm pretty confident putting that back to 99. I can't say that with certainty. Maybe I'd be more confident putting that back to 01, maybe 2000. Again, can't say that with certainty. So, no, as of a month and a half ago, right? No, we didn't really see really any increase in price reductions. And if people think the market is melting down, right, which it is not, it's not to say there haven't been some changes, but you would expect to see this metric rise, and we have not. Okay, here's where things get fun again. So we looked at annually, and then we looked at month, year over year, right? Just August. Now we're looking at months, month to month. We've got January of 2019 into Feb, into March, all the way through August of this year. Check it out. Look at the pattern, price reductions. Okay, so January, and I've marked our years right here, you guys. So this is 19, 2020 into 2021, sort of denoted that down there as well. So no surprise, January and December, if you want to get a listing sold, then you're going to have to be flexible on price, right? You're going to have to, well, I guess I shouldn't say probably, but there's a roughly 40% chance you'll have to consider reducing prices if you want to get it sold. So I guess I can't say you're more likely than not, but it's the highest chance you have throughout the year. Enter May and June of the year, the sort of spring, summer selling season, only 20%, right? So only about 1 in 5 needed a price adjustment. What the heck happened last year? Well, we know what happened, but how did it affect price reductions or price adjustments? Okay, so 40% started off at about the same. Came down, here's April. So April, May, June. So it looks like price reductions were rising. So April, May into June, which by the way, look, actually, usually we fall April into May, right? We usually fall April into May. Let's see here. This year, April into May, we fell. Last year, April into May into June, we rose. Come June, July, the prevalence of price reductions actually declined, and that never happens, right? Because of the strength of the market in the second half and third, third and fourth quarter, you see this sort of double dip type thing. Usually it's just a U shape, right? Like we see here. This was a double U shape. Pretty interesting stuff. I say that about all my charts. Cash deals, my friends, as a percentage of all sales, 12.5% year to date. So be careful. You know what? I haven't plotted it. I'm not sure if there's more investor activity in the winter months. I guess I've heard there is. Remember, though, this may be a proxy for investor activity, but not all investors pay cash and not all cash buyers are investors. Sort of a squares versus rectangles thing, maybe. Look at when the market was on sale, when prices went on sale after the Great Recession and the mortgage and foreclosure crisis. 23% of our deals were financed entirely in cash. 23% of our deals. Used to be 4.5% to 5%, right? And even as we've clawed our way out of that Great Recession, we still see heightened levels of cash in the market. And I wonder if people see residential real estate as more of an investment class, as an investment asset class. Could be. Urban market share, percentage of Twin Cities metro-wide sales taking place in, maybe I shouldn't say in Minneapolis or St. Paul. It turns out you cannot take place in both. But yeah, I think you guys get it, happening in the two core cities. So take a look at our condo bubble, right? 09 into 10. Look at urban market share, right? Soaring to what, 22%? You guys can see it was on its way up. We had that back to the city movement, urban renaissance. You saw a lot of condo and loft conversions in the North Loop. You saw Grant Park, Skyscape. You saw condos in Loring and elsewhere. And so you saw a lot of that activity. And then there was no land to build on, right? Then we started having the shortage. And the only place builders could really go is into suburbia, right? And not even inner ring, not even St. Louis Park and Richfield or even Bloomington. I mean, you're kind of talking second and third ring. Let me do my little trick here again. Okay, so April of 2020. We saw urban market share decline after that. It looks like it was declining before that as well. However, we actually have registered a pretty notable increase. And it's actually gotten this indicator back to, multi-year highs, 5-year plus highs. Maybe some of you would be surprised to learn that the percentage of sales happening in our core cities is actually as high as it's been in several years. That wasn't the case just a few months ago. So that is a recent development. Oops. Okay. A little bit of a sneak peek from our upcoming white paper that's hopefully going to be released in the next few weeks. Change in new listings, Minneapolis versus the suburbs. We see a pretty notable divergence here, don't we? Look at Minneapolis seller activity versus the burbs. Pretty notable. How about demand? So forgive me, guys, my charts aren't scaled kind of the way I want them to be. So Minneapolis here, 30%, but look at sales, right? Sales are also, about 30%. So it looks different just because of the axis scaling. So just work with me on that. Demand has surged far more in Minneapolis than it has in the suburbs. Sales activity are still growing in the suburbs. Sales activity is still growing in the suburbs, subject verb agreement there, but not as quickly as it is in the city. This is an interesting one. Month supply of inventory, city versus suburbs. You guys will notice Minneapolis used to have a tighter absorption rate than the suburbs, right? For the longest time. I believe it will again. It may take some time, a year or two, but I believe it will again. Something changed, right? Suddenly the suburbs actually had tighter absorption rates than Minneapolis. One more interesting note here, and let me do my little zoom in trick, not to get too into the weeds. Okay, so here's, March, April of 2020, right? So, okay, things crossed, but look, absorption rates in Minneapolis had actually been rising since 2018. So, can we call this purely COVID caused? I don't believe we can. Did COVID accelerate the trend? Absolutely. I don't think there's argument there. Whether COVID was the exclusive factor that caused it, I'm pretty confident saying no, because that trend was underway. Now, it could have just been because of the supply crunch that folks were just finding, millennials aging into home ownership, a lack of inventory. Folks were just going elsewhere to find these units. And so, we can see that showing up in the data. Okay, time check. I am moving way too slowly. So let's speed up a little bit here. Active listings under 250K, St. Paul, you can see the trend there. Minneapolis, significantly lower, 33 versus 52, but up a little bit. There's the metro. So yes, prices are rising as we've seen, but payments aren't really rising nearly as much. Here's our 30-year fixed. It has been on the uptick, right, to almost 3.1%. You guys can kind of see a little bit of that uptick there. We actually hit 2.67% as an all-time low. It was 2.65 as our all-time low. Oops, I didn't mean to advance that quickly. So look at 06, you guys. The last time prices were anywhere near this high was last year. And last time before that was the year before. I should say our last cycle peak, right, in 06. But look at what we financed those homes at. Look at what we financed those purchases at. 6.7, 6.8%. So sure, prices are now up here, but rates are down here. Let's sum this up. Median home price here in dark blue at all-time highs. Okay. Mortgage interest rate here in light blue at or near all-time lows. Monthly homeowner costs, PITI payments, right? Principal, interest, taxes, and insurance. Actually, monthly payments, while they've been rising, maybe they actually aren't above their previous peak before inflation, right? So really rates have been a saving grace, right? Low interest rates have offset the rise in home prices, and it has kept payments relatively stable. I'm not arguing we don't have affordability challenges. We do. This is a good lens to look through just as we're thinking about this stuff. Okay, August, over 1 million. How's luxury doing? How's this luxury segment doing? 51% jump August of this year compared to August of last year, right? We only had 62 in the bubble of 06. We really only had 62. How about September? We came down 0.8%, right? We came down 0.8%. Now, some say that there's two places you notice market shifts first. Urban, right? Cities, core cities, and luxury. I don't know if this is the beginning of a trend. I just can't say this. I just can't say that. Let's do my best Yoda voice. 1 month does not a trend make, young Skywalker, right? So, okay, down a sale, down less than 1%. And so, maybe these gains aren't sustainable. Maybe a lot of the folks that would have purchased now, million plus, have already made their purchase. So a lot of different sort of analysis or spins there. But just know we did not show a gain in million plus, although we showed a huge gain for million plus in August. Number of offers per listing used to be 5. I know some of you have gotten 20 or 30. And then again, I know some of you may have had listings on, even last year that after a couple months, may have only gotten a couple. Is it updated? Is it turnkey? What neighborhood, schools, walkability, so many different questions. So we're all the way back down to about 4 offers, right? Down from 5. Clearly well ahead of our average over the last 4 years. Let's talk just for a second about purchasing power, right? So interest rates 3%. If you wanted to keep your payment steady, right? Stable at 1220, $1,230, call it $1,240, whatever. As rates rise, look what happens to your home price. Look what happens to your purchasing power, right? Rising rates erode your purchasing power. Duh, right? That's kind of a duh. But what's not so obvious is just how much. So, 3 heading into 3.25. I don't think we'll see 3.25 end of this year, but it's very possible next spring. Also, what's our long-term average on the 30-year fixed? Little over 8%. Even if we do go to 4%, that is half of our long-term average. It is a phenomenal rate, historically attractive rate. But I know some millennials who are kind of older millennials who are saying 4% interest. Are you kidding me? How will we afford food and heat? Right? How quickly we become spoiled by the recent past, right? How quickly we become conditioned and accustomed to the recent past. Sub 4%, sub 3% interest rates are not normal, not even a little bit. But I think people are seeing them and feeling that they are this new normal. I think we'll have incredibly attractive rates for several years to come. I do not think we'll be below 3 or maybe even 4 in several years, but I can almost assure you we will be below that 8% average for years to come, which means mortgage rates will be better than average, right? More affordable than average for years to come. So you guys can kind of see what happens as rates rise. Speaking of rates, a lot of talk about inflation and interest rates as they've been creeping up. Let's just take a look. So Freddie, Fannie, Mortgage Bankers Association, and then NAR, the National Realtors Association. You guys can see heading into later this year, we're about 1/10 away from here. What do we show? 3.09. So what? 8 bips, 8 hundredths. Yeah, so we're getting there. First quarter by early next year, 3 1/3. Middle spring, summer next year, little under 3.5. By late summer, early fall, little over 3.5. Nothing too crazy to write home about. Price increases this year, folks are thinking almost 12%. I wouldn't be surprised at all. I think we're on track for that. Maybe we'll be more like 10, 11. But then interestingly, but this Pulseonomics survey shows, economists and analysts are kind of forecasting a normalization. Notice, over the next 4 years, they are not forecasting a decline. They are forecasting a more moderate rate of growth, right? A slowing rate of growth. Still a growth rate, but not quite the growth rate that it was. And as we like to say, I will stop in the name of love. And before we open it up for any questions, I do just want to highlight very briefly for you guys. Not all of you are aware, so I have to showcase this. mplsrealtor.com, our market data section. We have all of our many, many wonderful reports. One of our newer reports that you guys may not be aware of is sortable stats. It's really a magical thing, right? So we've got our communities, we've got our neighborhoods. Sure, fine. We even had St. Paul neighborhoods. I'm just kidding. We love St. Paul. And then we've got cities. And so 2 things we can do. And let's just do price for now. I can sort by price. When I click this, I'm sorting by price from high to low. Wow. Who would have thunk? Lake Minnetonka area, highest price, right? And then we have some of our more affordable markets in Powderhorn, Phillips, and Northside. Minneapolis neighborhoods, Linden Hills, no surprise, little over $1 million for a median sales price. How many sales? 17 sales. Half were above 1.04 million. The other half were below 1.04 million, right? All right, Kenwood. Okay, so, that makes sense. That's sorting by the price. What if we sort by the change in price? Interesting. Here it's actually Phillips that we see, is the fastest gainer. Calhoun Isle, Uptown, University. You've got Dinkytown and Marcy Holmes. There's your Southwest with Fulton, Kenny, Armitage, Kingfield, and Linden Hills, and Lyndhurst, I think is the one I missed. And so you guys can do that with sales, prices, market times, absorption rates, and of course, one of my favorites, this ratio of sold to list price. Who's got the highest? Harrison neighborhood at about 107, near north at 106. McKinley, also up in Camden, in the north side, also about at 106. How about cities? Place your bets. St. Mary's Point, that's a weird one. Jackson Township, our research and policy specialist would love that. Empire Township, I don't even know what that is. I think I've seen it on a map. Here's North Branch, 107.4. Woodland showing up here, a couple others showing up here. So some pretty interesting data and pretty interesting insights that you guys can see there. Okay, really quickly, let's see. There's that WCCO story. Let me hop into, not back into my presentation. Let me hop back into North Star really quick. I just want to show you guys. And forgive me, I thought I was logged in. I should have been. I also thought I remembered my password. Okay. Yes, I promise I will read that later. Info Sparks. Just a little refresher in case there's any new folks on the webinar today, or maybe some seasoned folks and frequent flyers who just need a little bit of a refresher, right? Landing page, we're looking at Twin Cities region. I can change and pick any area or school district or zip code that I want. We're looking at median sales price, 330 over the last 12 months. Just for September, there's our 341, right? We can look at days on market. There's our 11 days, right? I just showed this to you guys, right? It's right here. I'm not making this up, I promise you. Percent of original. There's our 1012. Are you guys noticing a pattern? I am. Right, there's our 1012. Let's say we want to throw on, now we want to throw on a Minneapolis. We want to throw on fine, we'll throw on a St. Paul. Okay. Interesting, Minneapolis, a little flatter than the rest. St. Paul over 100, Metro as a whole over 100, right? Pricing, Twin Cities region, Metro kind of taking off a little bit ahead of Minneapolis, and then our friends in St. Paul bringing up the rear of the affordability train. Maybe I shouldn't say the rear, the front of the affordability train. The rear of the price group here, but leading the way on affordability, I guess, of these three geographies. So tons that we can learn here. Price per foot. If you think the Metro has here already, guys, this is fascinating. Great example. The Metro has bigger homes than the city, right? Lennar builds, 3,200, 2,800, 2,500 square foot homes. Minneapolis has a lot of 1,400, 1,600 square foot homes, some 1,200. So look, price per square foot of 222 in Minneapolis, call it 225 versus 175, right? So those are important differences. Even though sales price is higher in the Metro, price per foot is higher in the city. That's the beauty of using, all these different areas, all these different metrics. And don't forget, if you just want to look at single family, boom, you can do that. If you want to rule out new construction, we can just pick previously owned. So just know that you guys have access to this. I think everyone's paying 10 cents, 12 cents, 14 cents a month for this or something. So, use the data, use it for good and never for evil, right? We can share it and kind of take a look at it, and you can email this, you can use it on social media. So please use this data in your marketing, use it with your buyers and sellers, and use it to grow your business and help you better understand the market. And I think I am 30 seconds over, and so I will open it up for questions, if there are any, briefly.
Awesome. Thanks, David. I'm not seeing any questions at the moment, but if anybody comes up with questions, we do have a market data ask and learn every other Friday. So the next one will be on the 29th from 1 to 2 p.m. And you can find the link to that on our website. So I would encourage you guys to come to that as well. And then again, just a reminder that David's presentation from today will be sent to you via email and on our website. So thanks for all of you for joining, and I hope you enjoy your weekend.
Thanks, guys. Thanks, Ann.